Hello, good morning, everybody, from Redmond, Washington. This is Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's an absolute pleasure to be with you, and it's a real pleasure to be here in Redmond in the StockCharts.com studio for this episode of Your Daily Five. I'm going to jump right in because, as you know, I've been bullish. Been bullish for a long time. I continue to be bullish. However, I do recognize when we've got short-term problems, and we certainly have some of those short-term problems right now. Let's take a look at the charts. Anytime we get a breakdown, the first chart I go to, or one of the first charts I go to, is the Volatility Index. And here on this chart, what I've done is I've gone back the last 10 years, which spans the entire secular bull market that I believe we're still in. But if you look at the VIX, I've put a few horizontal lines in here, and each one gets a little bit darker as that VIX goes up, because to me, that starts to talk a little bit more about the severity of the decline that we're experiencing. So if you look first, anytime the VIX gets up to 20, that's kind of the first little bell ringing in the background for me that, hey, things aren't quite like they've been. And if you know much about the VIX, you know that the higher the VIX goes, the faster the market falls. So anytime we start getting up above these levels, it's really important to me to just be patient and allow the market to play out. So here on the VIX, the 20 level, you'll see going back the last 10 years, we've had many moves above 20 on the VIX, and currently we're sitting at 21.5. So this isn't anything new throughout this secular bull market, but it does tend to coincide. These types of levels on the VIX do tend to coincide with big moves to the downside in the S&P 500. If you look at the bottom panel, you'll see that throughout this entire secular bull market, the S&P 500 just keeps moving higher. Yes, we'll have some pretty scary lows from time to time, and we'll see that VIX escalate up into the 20s, 30s, even 40s or higher. But just understand that getting up into the 20s is not the end of the bull market. It's a matter of how much further might we go down before we find a bottom, and that's really what I'm looking for in the charts that I'm going to show you today. So the volatility index, we know it's a problem, but we also know if you look back, many major bottoms, significant bottoms in this secular bull market have occurred when the VIX has hit 20 or just gone a little bit above it. So if you go back and look at all these prior VIX readings and then look at the corresponding lows on the S&P 500, you'll see that there is quite an inverse correlation in terms of tops on the VIX marking bottoms on the S&P 500. The second chart I want to show you is let's take a look at that S&P 500, because anytime we get breakdowns, there's nothing more important to me than price volume, that combination. So you hear me talk a lot about intermarket relationships, and I try to kind of gauge what I think the market's going to do based on those, but there is nothing more important than price volume. So here on the S&P 500, obviously you can see we've been trending lower. I've got a channel that's marked, and we're right at about the bottom of the channel. We'll see if that makes a difference or whether we break through this channel to the downside. But currently, the S&P 500 is at 4135, which is down about 1.2% today. It is below one of the first key support levels that I was watching, which was pretty close to the 4,200 level. And I've got another low down here marked at about 4,050, which coincides with the lows that we saw in April and May. If those don't hold, I mean, it's possible we could go back to that March low. I don't believe we're going to go down that far, but I think if we lose 4,050, that would certainly bring it in. So just recognize, first of all, that we are losing support. And so even if you're bullish, you don't want to be trying to be a hero and jumping in front of a freight train when this market's going lower. What I would like to see is some sort of a capitulatory move to the bottom, maybe a long tail, big reversal in the afternoon, that sort of thing where it looks like we've got nowhere to go but down, and then all of a sudden we come back. That's an indication to me that maybe market makers are using their vast resources and actually starting to buy stocks in large quantities. So that's what we want to look for. We want to see that long tail to the downside, some sort of a big reversal in the afternoon. Now, I put some numbers up here, percentages. When I was doing charting forward with David Keller, I think it was in September, maybe around the middle part of September, I said, hey, you got to be careful because we've got a big historical bearish week that goes from September 20th to September 26th. And if you look at the chart on the S&P 500, that period we absolutely took another big drop. Well, I'm here to tell you that we are in the worst week of the year. So I've been warning a lot of our members at Earnings Beats that you really want to pay attention to the rest of this week, because historically we typically see bottoms go in around October 27th. That's kind of a key date, and all of a sudden the market acts as if there's nothing wrong. So the last 2 days of this period is today and tomorrow. Today, the annualized return for October 26th since 1950 is minus 56%. 27th is minus 24%. Now, keep in mind that the S&P 500 has gone up 9% a year on average since 1950. So if every trading day was equal, we would see mostly 9% up days. Well, you can see the 26th and 27th very, very weak, and that goes right along with what we saw earlier this week. So since October 22nd, which was actually Sunday, the 23rd through the 27th, told us historically you got to be very careful, and you start getting breakdowns to go along with it and the soaring VIX, and you can get what we're getting this week. But here's the interesting part. After the 27th, the actual close on the S&P 500 from the 27th of October through January 18th, that period has ended higher 62 of the last 73 years. Pretty high percentage. And let me just read off to you the annualized return starting on October 28th. And yes, I know the 28th is Saturday, the 29th is Sunday. Of course, we're going to have 2 days of weekends every week. But starting on the 28th, look at these percentages over the next 9 days. This is the best 9 consecutive day period of the year historically, and the second best isn't close. October 28th, up 126%. October 29th, up 77%. The 30th, 56%. 31st, 16%. The 1st of November, 43%. November 2nd, 72%. November 3rd, 95%. November 4th, 53%. November 5th, 73%. None of these numbers, well, outside of October 31st, none of these numbers are even close to 9%. These next 9 days after Friday's close, this is the start of the most bullish period of the year historically. That's just a secondary piece of news to be aware of. Doesn't mean that the market's going to absolutely fly starting on Friday. It's just tendencies. And that's what we want as traders, is to understand market tendencies so we're better prepared to trade. So if we got a big reversal today, big afternoon buying, maybe tomorrow, maybe we gap down again tomorrow, have another big day, and maybe it's next Tuesday. I don't know when it's going to be, but what I'm looking for is some sort of a big reversal. Now, let me go on to the next chart. This is the Nasdaq 100, the NDX, and I'm just going to show you basically the price action. You can see that we are clearly within a very strong channel to the downside. So ultimately, I want to get a break. But if you also notice here, this was a pretty key support area on the NDX, which was up at about that 14,500 level. We broke down, closed below it yesterday, and you can see how selling is accelerating. There's no reason really for most technicians to jump in on this NDX. So what I'm waiting for again is market makers to show me that they're ready to start buying. And I think once that happens, we could print a very significant bottom in the market. But I don't want to try to predict when it's going to be or start, getting too aggressive. I want to see that print, that bottom print, before I get excited. So we got this channel to deal with on the NASDAQ and also the breakdown from the last couple of days. How about the IWM, Russell 2000 small cap? Again, been in a very lengthy downtrend since mid-July. But if you look at this, I've actually pulled up a 10-year daily chart. Numbers not really that important, other than one key number around 160. Because if you look back to 2018 and 2019, 2020, in this 3-year period, tops were pretty clear right around this 160 to 162 area, and I've marked those with red arrows. We broke out above that latter part of 2020, pulled all the way back, and we've put in a double bottom, maybe even triple bottom, down at around that 160 level. So it is, that's like, technical analysis 101, where you have prior technical resistance, resistance, and it's broken. And then when you come back down, that creates a floor or support for price action. And that, I think, is beautifully illustrated here on the IWM chart. So we're right now at 163 and change on the IWM, knowing that we have major price support right at about 160 to 162. If we were to go, bottom at 158, 159, I think that would be okay. We start seeing 157, 156 print, we've got some real problems in the small cap area at that point. So continue to watch this area. 160, I think, is going to be very, very important on the IWM. Now, it wouldn't be one of my episodes probably if I didn't talk a little bit about individual stocks, because after all, we are earningsbeats.com, and it is earnings season. So I want to give you 3 charts that I laid out. This was at an Earnings Beats event back on Monday evening. We did a sneak preview of upcoming earnings reports, and I like to look at relative strength as one indication of some real strength in stocks as they head toward their earnings report. If a stock is showing leadership among its peers, normally that's a pretty good indication that I should be expecting a pretty good report. And obviously on the opposite side, if relative strength is very weak and we're seeing stocks trending lower relative to their peers, it's probably an indication Wall Street doesn't, not too excited about what's coming up. So I'm going to go through 3 charts pretty quickly here, and let's take a look at what happened with their earnings, because these 3 companies have all reported. So the first one was Manhattan. Actually, let me go ahead and start with Manhattan, because on Monday, this was one of the stocks that I said, I really feel strongly about this company having a really solid report. We had gone down and tested some prior lows right before earnings, but I want you to look first at the AD line, which has been continuing to rise, and then also look at Manhattan relative to the software index. It's been rising throughout the past year, and if you look at the software group relative to the S&P 500, you'll see basically the same thing, a line that's been going up for the last year. So we have a very strong industry group in software, and we've got one of the leaders in terms of Manhattan, the way it's been performing relative to its peers. And so I expected good numbers. What did Manhattan report? Revenues, $238 million. Market was expecting $226 million. EPS, expectation only 77 cents. They came in at $1.05. Now, when you come through with these great earnings, you don't always get a great reaction. That's the thing about the stock market. It makes everyone scratch their head. It's like, great report. Why is the stock down 3%? And if you look at Manhattan, it actually gapped down the day of its earnings, or the day after its earnings, went down to 2 or 3% at the open, and then came rallying back. I would watch this support area, maybe down just a little bit above the 180 level, but I really like Manhattan. I think they had a blowout report. I think the big problem with Manhattan right now is simply the overall market environment, which, we continue to see prices go lower. It's hard for prices to go up much when the overall market is on such a trajectory to the downside. But watch this one. I think Manhattan could be a great stock as we go forward. Second one, Logitech. This is another one that I said back on Monday. I thought we'd have a pretty good report. And look at the numbers. Revenues came in $1.06 billion. The expectation was actually under $1 billion, $0.98 billion. So $800 million above expectation. Look at the earnings per share. Wall Street expecting 66 cents. We came in at $1.09. Huge beat there. Look at that gap reaction, the market reaction next day. We got the gap up, big breakout. We are pulling back down close to at least the top part of gap support. We'll see if that holds. But breaking out to a 52-week high in a market like this, obviously Logitech is in favor right now. Last stock I have for you today, I want to talk about TNET. This was actually our Earnings Beats Digest chart of the day. You can go over to earningsbeats.com. You can sign up for our free Earnings Beats Digest newsletter, and you'll get charts like this one. But TNET was one that I said, hey, I expect that we're going to have some really good numbers, because this stock not only has been going up in a down market, but if I scroll down here, I want you to look at what's been going on with Business Training and Employment Agencies Group. That's TNET's peer group. Been going down and near a 52-week low. So TNET not only is in a bad market and not only in a bad group that's underperforming the market, but it's outperforming, moving higher, and recently setting new 52-week high in this market environment. They came through with great numbers, $348 million in revenues versus $315 million, and the earnings per share, $1.91 versus $1.42. Not even close. Wall Street was way, way shy of what this company is actually doing. So this is another great company to keep an eye on. If the market rebounds, I would expect companies like these three that have reported great numbers to actually start leading the market back to the upside. All right, that is it for me. Again, it is so nice to be out here in Redmond, Washington today. Seeing all my friends here at Stock Charts has been a real pleasure for me. Being able to broadcast this Your Daily 5 to all of you from the studio is a real pleasure as well. And let's just be careful here. No matter how bullish I am, and I'm very bullish long term, I don't mess around with breakdowns. The market, maybe I'm wrong. Maybe this market's going a lot lower. So I think you have to be very careful here, whether you're looking at it from your own bearish view. Even if you're bullish, I think you've got to respect these breakdowns and wait and wait and wait until the market starts to give us a signal that we've got some buyers coming back into the market. Anyway, everybody have a great day. Really appreciate you tuning in. Happy trading, everyone.